Hi, I'm Jose Armenta, and this is your Federal Employee Benefits, where we cover topics in helping FERS federal employees like you make smart financial decisions. Today, we're going to cover three big FERS pension and TSP mistakes that federal employees really can't afford to make. Now, if you're new here, make sure you hit that subscribe button so you don't miss any future videos. Okay, let's get started. Okay, so the first mistake that I frequently see federal employees make is planning their retirement with their gross pension amount and not the net pension amount. Okay, now knowing the difference between the two is critical because the amount you'll receive in retirement is going to be your net pension amount. Okay, and if you're planning with the wrong retirement numbers, you can end up with an income shortfall when you enter retirement. Okay, so let's look at an example of exactly what I mean when I say net pension. Okay, so in this example, we're going to say federal employee Bob has a gross monthly pension of $2,000. Okay, so he computed his pension. The quick reminder: the pension formula is your years of service multiplied by your high 3 and by a pension multiplier. If you don't know how to do that, I have a video on that, a very quick video to show you how to do that. But in this example, his monthly pension, gross monthly pension, is $2,000. Now, the deductions where you're going to deduct from this amount to get your net pension will vary from individual to individual. But here we have the three common deductions. Okay, so you're going to have your survivor benefit. For Bob, his survivor benefit is 10%, so he's going to subtract $200. Taxes, federal and state for Bob is $350, so we subtract that. And then his FHB premiums are $400 a month, and so he subtracts that. The result is his net monthly pension, $1,050, okay, which is nearly 50% of what his gross pension was. Okay, now that won't always be the case. Okay, some individuals are going to have deductions that are not going to take up that much of a percentage of their pension. Okay, but these are realistic numbers. I've seen similar numbers. So some individuals, their net pension will be significantly different from their gross pension. Okay, it's just going to vary from federal employee to federal employee, but there is going to be a difference, and so you're going to want to know what your net amount is so you could plan with that number. Okay, the second big mistake that I see federal employees make is failing to create tax diversification. Okay, now what exactly do I mean by that? Well, if you are a subscriber to this channel, then you have heard me say it plenty of times that you as a federal employee have great benefits. Okay, you have great retirement benefits. Okay, but your retirement benefits, your first pension, your Social Security, your traditional TSP withdrawals, they're all taxable income. Okay, and they're going to be taxable at what's called your ordinary income tax rate. Now, why is this a problem? Well, it's not a problem per se, but it's not ideal. Okay, and the reason why it's not ideal is because you have three different types of tax accounts that you could be saving in that would lower your tax bill in retirement. Okay, it would be more efficient and you'd pay less taxes. Okay, now when I say you have these three different tax type of accounts, think of them as buckets. Okay, there's three different buckets, and depending on which bucket you have your money in is going to dictate the tax rate that you're paying. Okay, now to give you an idea of what I mean by this and to make things easier to understand, let's look at an example. Okay, where we'll start off by looking at the tax rates in each bucket. Okay, so the first table here, okay, think of that as the first bucket. Okay, those are the ordinary income tax rates. Okay, so your pension, your first pension, your pension supplement, your traditional TSP and IRA withdrawals are going to be taxed at these rates here. Okay, so if you're married filing jointly, you'll have those income thresholds there. So those are ceilings, meaning for a married person filing jointly whose income is $22,000 or less, their marginal income rate, so the rate that they're going to pay on the last dollar of their income, is going to be 10%. Okay, but as soon as they make $1 more than $22,000, they're going to go into that next tax rate. Okay, and so they'll go to that 12% marginal tax rate. Okay, and so the amount of taxable income that you have at the ordinary income tax rate can push you up into the higher tax rate. So the more ordinary income that you have, the higher the tax rate you're going to pay. Okay, so that's very important to understand when you're trying to lower your tax bill and use the different tax buckets. Okay, now if we look at the second tax bucket here in the middle, the non-retirement account, okay, this these accounts are gonna have qualified income. It's called qualified income, and they're gonna pay preferential tax rates. Okay, they're gonna pay either 0%, 10%, or 20%. And again, it's gonna be based off of taxable income. And for those married filing jointly, if they make 89,250 or less, then they will actually pay 0%. Okay, 0% on their capital gains or qualified dividends. Okay, those are two types of qualified income. Okay, now again, this is the income that would come out of your non-retirement account. Now, the last bucket here is the Roth TSP bucket, okay, or Roth IRA bucket. So this is for your Roth accounts. This money here is tax-free, okay, as long as you meet some of the rules, which most of you in retirement are going to meet, okay, namely having the account for at least 5 years, which most folks who are in retirement are going to have their Roth TSP or IRA for longer than 5 years. You can take qualified withdrawals, and those withdrawals will be tax-free, okay? So having diversification and being able to have your retirement savings split among these buckets can be very useful in retirement. It's going to give you a lot of flexibility, and we're going to see what that flexibility looks like in the next slide here, okay? Now in this next slide, what we see is we're going to say Bob, right? Our federal employee Bob, our favorite federal employee. His goal is to have $90,000 withdrawn. Okay, he wants to have $90,000 gross a year. Okay, that's his retirement goal, his income goal. Now, in the first bucket here, okay, there is no tax diversification. We're going to say Bob has no tax diversification, and so his pension is $60,000. So that he can get that $90,000, he's going to need to take out $30,000, right? So he has an income gap of $30,000, and he's going to fill that gap by withdrawing from his TSP. And so that's where you see that red $30,000 traditional amount there. Okay, so that's the amount that he needs to pull from his traditional TSP to make up that $90,000 goal that he has. Okay, so all of that income, because he has no diversification, he has only money in traditional TSP, which is going to be taxed at the ordinary income tax rate, just like his pension. All of his income is taxed at ordinary income tax rate in that first bucket. Now, let's look at what his tax bill would be if he had some diversification, and how he would withdraw and create flexibility with the diversification. Okay, so same pension amount on the right bucket, $60,000. He's going to take out $10,000 from his traditional TSP there in the red. Now, because he has a non-retirement account with a substantial balance that he has saved over the years, okay, he's able to take out $10,000 a year. So he's going to take out $10,000 from that. And because his income is under that threshold, okay, his ordinary income is under the threshold for the 0% in qualified income, okay, that middle bucket, his $10,000 in non-retirement and qualified income withdrawals is going to be taxed at 0%, okay, because he has not surpassed that income threshold that we saw there in the last table for qualified income, okay. His qualified income, his taxable income is under that threshold. He will pay 0% tax on that non-retirement withdrawal, okay. So that's huge. That's a huge benefit he has there. Now the next $10,000 he's going to pull out of his Roth TSP, okay. And again, because he has he's making qualified withdrawals, this TSP withdrawal will be tax free. Okay, the Roth TSP withdrawal will be tax free. So he has $20,000 of tax free money coming out from these two different accounts. Okay, and the result is there. His tax bill is $4,636. Okay, so significantly less than had he not had diversification. Now, creating this diversification does take time. Okay, it's not something that you want to do right before retirement, because taking out a lot of money from your traditional accounts can push you into the next tax bucket and then eliminate some of the tax savings. You're just going to pay a lot of taxes up front. So this is really something that you want to start doing early in your career or mid-career, when you have at least 10 years to gradually build these different buckets. Okay, and the third and final mistake that I see federal employees make is not knowing the difference between a rollover and a transfer. Okay, when they're moving their TSP to an IRA, some federal employees make the big mistake of using a rollover. Okay, now the difference, between a rollover and a transfer is that a rollover, okay, the TSP, and when you use a rollover, the TSP sends you a check. Okay, sends you a check for the balance of the rollover. So let's say you have $1,000,000 in your TSP and you're moving into an IRA and you elect to do a rollover. They're going to send you a check for $1,000,000 payable to you. You're going to take that check, deposit it, and then you're going to write a check to whoever is holding the IRA that you're moving the funds to. Okay, whether that be Schwab, Vanguard, whoever. Okay, so it's a three-step. The money moves twice. It goes from the TSP to you, then to the new custodian. Okay, now in this process, when you do a rollover, the TSP is going to withhold 20%. Okay, so if you're rolling over $1,000,000, they're going to send you a check for 80% of that, so 800,000, and you're going to have to make up that 20% that they withheld. So if you rolled over $1 million, TSP will send you a check for 800,000. You're going to be expected to send that new custodian $1 million. You're going to have to find that 20% somewhere. Okay, you're going to find that cash somewhere else and make up that 20% to complete the rollover and to not have it designated as a distribution. Okay, so for example, you do the rollover again. You do a rollover for $1 million. TSP withholds 20%, sends that 20% to the IRS as estimated taxes. Okay, you receive a check for 800,000. You make up the 20% by pulling funds from, let's say, your savings. Okay, so you have to find 200,000 of savings. Okay, add that to the 800,000 you receive, send that full million balance to the new custodian to complete that rollover. Okay, once you do that, then when you file your taxes, you will get a refund for that 20% that was withheld. Okay, but it's a big hassle, and you may have to find a large amount of cash. Okay, depending on how big that rollover is, you may have to find a large amount of cash to make up the difference for that 20% withheld. Okay, versus if you just did a transfer, that step would be much easier and you wouldn't have that withholding. Okay, and with a transfer, the TSP sends the funds directly to the new custodian. You don't touch the funds. There is no withholding. The funds just go from the TSP to the new custodian, and that's it. Okay, much easier. There is no headache of you having to find the extra funds, and then no chance that the rollover will have a taxable consequence. Okay, because again, if you don't make up that 20% difference, it will be designated as a distribution, and then there will be a tax consequence there potentially if it was a tax deferred account. Okay. And those are the three big mistakes to avoid. Okay, just remember, you want to use your net pension, not your gross pension. Okay, when you are creating tax diversification, although that is something that you should be doing early on or mid-career, preferably, okay, there are some methods for creating some diversification later on when you're approaching retirement. You can do Roth conversions, just depends on your income level, and then when you're going to start Social Security and whether you're going to work in retirement. So there's some things to think about there. And then also, when you're doing when you're moving funds from the TSP to the IRA, remember you're going to want to do a transfer, not a rollover. Okay, I hope you found this video helpful. If you did, hit that like and subscribe button. That's the best way to support this channel. And until next time, I'm Jose Armenta. Take care.